Hi, I'm Russ Hissam from Utility Accounting and Rate Specialists. Thanks for joining us on this GASB update from January of 24. This one's on GASB 96 Subscription-Based Technology Arrangements, the SBTA. It's for cloud computing contracts that you have on various types of software. And we're going to cover this quickly. This will be one of those quick updates, easy to implement, not too hard of a concept, but another thing that GASB has thrown our way that we need to account for. So, GASB 96, you can dance the SBTA. That sounds a little jazzy, right? You can have like a flamenco dance, or maybe a line dance, or the dance of your choice. But in any case, jazzy and GASB don't necessarily go together. But this GASB 96 really is the rules for recording cloud computing arrangements. And it's effective for years beginning after June 15 of 22. So if you have a calendar year end of 23, it's in for you this year. And it's similar to GASB 87 leases. So if you have GASB 87 nailed, you'll have no trouble with this at all. It's the same thing except it's for cloud computing arrangements. And what it does is it recognizes the long-term software agreements as a long-term asset. So if you think of GASB 87 for leases, a lease is the right to use an asset for greater than 1 year in the future. And this is the same thing for software arrangements. So the SBTA is the right to use the software, and the items that you need to calculate the value of the SBTA are, first off, well, the contract. That's pretty obvious. Then the length of the contract. Remember, if it's less than 12 months, you account for it just the way you have been in the past. You expense it on a regular basis. But if it's greater than 1 year in the future, the right to use that asset, the cloud computing arrangement, then you have a SBTA that falls under GASB 96. So you need to know the length of the contract, the information on options to extend the contract, because that could change the value, the interest rate charged by the vendor for the SBTA, or if it's not stated, that we're going to use the weighted cost of capital of your utility or co-op, of your utility rather, and we're going to use that to calculate what the present value is of those future payments. And you need a spreadsheet too. It's a pretty simple spreadsheet exercise, but a spreadsheet will be handy. So first we're going to measure the subscription asset. And the subscription asset, the amount that you're going to book, discount, and amortize, is first off the initial subscription liability amount, so what you owe under the contract. To that you add any payments before the subscription term starts, and to that you also add capitalizable implementation costs. And I'm going to talk about what that means in the next few slides. So you'll have activities involved with this type of arrangement where you decide you need software, the idea phase, you study the needs of your organization, you put together a request for proposal, goes out to vendors, they do demos, you decide on somebody, all those costs get rolled in, so you're determining the needs, the vendor, you acquire the asset and the right to use the asset. Then you'll convert your data from your current system over to the new system, you'll train your team, and then you'll go live with the new software. Well, all those involve costs, and these costs are separated into various stages. Now, you might remember a grid like this when you were looking at GASB 51, which is, really old in accounting terms, and it had these same items on there: the preliminary project stage, the initial implementation stage, and the operation and additional implementation stage. And you might recall GASB 51 is for intangible assets, and software fell under that area. But at the time, cloud arrangements weren't very common because the internet wasn't as robust as it is now. So most organizations had standalone software. Well, that's changed. Now we're moving to the cloud. So we still have these three stages, but the activities under each stage get a different treatment. So first off, the preliminary project stage, that would be the idea, your business needs, the RFP process, request for proposal process, and selecting a vendor. Well, those costs get treated as an expense, just like under GASB 51. Then the next phase would be the implementation phase, data conversion, internal labor, other costs you might incur in getting the system up and ready to go to the go live stage, well, those costs get capitalized with the SBDA. Then you have the third bucket, operation and additional implementation stage. Well, that's ongoing training, ongoing costs, maintenance costs, things like that. Those are going to be expensed just like they were under GASB 51. So let's do an example. So here we have an SBDA arrangement with a software vendor, and we enter into a contract for 3 years, and the contract amount is $3 million. And so we're going to capitalize that as an SBDA asset and a liability. We have data migration costs, those get capitalized also, and we have training costs of $300,000. Those will be expensed. Nextly, you record the project costs. So you have, remember, the $3 million plus the $200,000. That is the cost of the asset that you have to get it up and running. Well, you book an asset, and FERC account 303 is for intangible plant. That's a good spot for this one. You also have a long-term debt of $3 million. We have the training costs here, and that $200,000 of other costs, remember, those are out-of-pocket costs, so you paid for those already. And that goes into this $500,000 credit to cash. But now we have to book the SBDA liability, and we want to amortize that over the period of the contract. So we use a discount rate that's equal to the weighted cost of capital of the utility. In this case, we use 5%. So we took that $3.2 million over 3 years, discounted it at 5%, and we came up with a provision for depreciation and amortization of other utility plant of $1,066,667. That goes with the annual amortization amount of the same. So remember, you have that liability, you'll make your payments, you'll parse them between interest and principal just like you do with a regular lease, and you'll have this amortization factor of that, which you will write off over the 3-year contract period. So not too complicated, and you can throw a few wrinkles in there where you have additional situations where you have contract modifications. There you want to remeasure and adjust the contract for the additional cost or reduction in cost. Or if you terminate early, you'll have a gain or loss on the disposal of the asset and the termination of the contract. Now the question comes up, well, now we have a SBDA as a liability. We never had that before. We just paid on an ongoing basis. Is this now debt? If I want to go out and issue bonds, does this fall in that bucket with leases where now we have debt where we didn't have debt before? Well, common talk has been with financial advisors and the rating agencies, and they say right now that's not really considered debt because you're not really changing anything you've done in the past. You're just recharacterizing the transaction and going with the movement of putting all these off-balance sheet liabilities back on the books and stating them on the face of the financial statements. So that's it for GASB 96. Pretty easy implementation, simple. You gather the costs, you discount them, you book them, you amortize the cost, and you're done. So thanks for sitting through this discussion on GASB 96. I hope it was helpful. We have more information and articles at our website at utilityeducationinsights.com. Check it out, and good luck with your GASB 96 SBDA, and put a little jazz in it. It's a lot more fun that way. Thanks a lot. See you soon. Bye-bye.